Hello, today is the 22nd of September 2010, and this will be a technical analysis video looking at crude oil. Very recently, Mike Maloney had a little bit of an interview, or more along the lines of that of a speech, stating oil to go to low as $10 per ounce. So let's take a look at these technical analysis. The two-part series will be available in the more information box. Interesting little trend line that we have as we have established a downtrend line. Why do I say established? Because every single time we have tried to create a downtrend line, it only had one hit on it and got above it. We can see here it has one hit, gets above it. We move the trend line up, same thing here, same thing here, same thing here. But now we had a situation where it hit this top and then it once again found a level of resistance. There is a significant support level here, roughly at around 68 per share, or $68 a gallon. And this is creating that of a descending triangle. Now, the moves that we've seen before in 08 was massive, going from about 150 down to about 32. That's a major significant loss that it had. And he's calling this move higher that of a dead cat bounce, which happens when you have a massive sell-off. It can't keep selling off forever. And then you have a significant rally, which would generally have another sell-off that may find support at its previous bottom and then eventually go lower. You can also make a case that this pattern is very similar to that of this pattern, because markets correct either through time or they correct through price. Here was a situation where the markets corrected through time before having this major surge higher. That's having a similar kind of pattern also within this chart. Now, as far as a line chart, same chart, but this way I can add in some moving averages. I have no idea how I can add moving averages on a candlestick chart, but this one works within here. And exponentially, the Fibonacci level of 82.54 has been a level of resistance that is encountered on a couple of occasions. So therefore, when you're looking at this chart, we are very neutral. Whenever we are in this range between 58 and 82.5, it's in a neutral range. We can see these moving averages. The 50-week and 200-week moving averages are crossing together, and the 200-week is very flat. The 50, which was declining, now it's rising. We can see the slope of the rise that it's had has reduced, which is showing signs that it is flattening out. Overall, showing a heck of a lot of indecision. Now, the difference with fundamental and technical analysis is if you know something fundamentally, you can get a huge advantage. When we've seen silver plummet in 2008 down below 14, 13, 12, you might have been saying, well, fundamentally, this makes no sense. Silver should be going much higher, so I'm going to be buying. Yet you're buying at 12.11. The technicals will be stating, well, it's in a downtrend. There's no reason to be going long. And the same can be said as far as this if the fundamentals for it to go lower happens to be true, as he mentions about the money contracting right now for a reason for it to go lower. And of the major indices, we'll say stocks got well above the 61.8% exponential Fibonacci. Gold and silver not only got above it, but they pretty much broke it. Gold, well, they're making new highs. Silver is at its previous high of 08. Where oil has been more of a lagger more than anything. So back to the point about fundamentals and knowing in advance. On a short situation, you really don't want to be shorting until it goes somewhere below 58 per ounce, because it's still in the neutral case. Anything above this area here is bullish, and everything below here is bearish. And like I say, if you know it in advance, then this is where you can put in whatever orders that, or whatever type of strategy that you can use that would be beneficial towards yourself. Now we're going to take a look at the chart once again, and the price target he's talking about is $10 a barrel. And the Fibonacci level that we're talking about is 58. Let's just assume that we have a move that maybe finds a level of support at the Fibonacci, gets above it, and then maybe then you could break below the Fibonacci. So now on a technical level, you might be shorting the oil maybe somewhere right in here. But on a fundamental level, if you know it early enough, you're getting in on it towards the high, for that matter.